Hey everyone, time for another market update. Been a little while since the last one, been a couple of months here. So we're going to be talking about what's been going on over the last couple of months, how deep this pullback could get, what what sectors are outperforming, underperforming over the last couple of months and over pretty much since March. And then I want to get into where the rotation from growth to value is really starting to pick up. And we could go over some sectors and some rotational ideas along with that. And the last point I want to talk about today is actively managed funds versus, say, ETFs, which are more passive, and an approach that I like to take at this moment in time, using actively managed for a certain portion of the market and then ETFs and passively managed for the other portion of the market. So let's just jump right in here. So you can see I already kind of marked this up a little bit, but what I really want to do here is let's bring this to a monthly and let's zoom out again. Always like to zoom out to kind of start these things off so you can really see how far we've come. And so here's your global financial crisis bottom, which was in March of 2009. Pretty much steady uptrend since then, right? So this is kind of what you like to see, where you kind of get away from the trend, come back and touch it, get away from the trend, come back and touch it. And now you're getting kind of this extreme version of volatility ever since January of 2018. What's really important to know about this, and this is kind of where technical analysis really helps me as far as when I should press, when I shouldn't press, when I should raise cash, when I should go all in. So in moments like these, when you get these dips here, right? Yeah, these three dips, these things are scary. The February 2018 was a really quick 10% drop. And I remember everybody back then saying how violent that was at 10, 11%. That all happened within a month. And the extent of that was about 11, 12% from top to bottom there. Fast forward to October 2018 going into December, it was about, I remember it didn't get down 20%. So it was about 19 plus percent, because they kept saying it almost got to a bear market, and a bear market is 20% from the highs. Then the pandemic hit, and I don't know if we've talked about this in the past, but so we had 35% drop, but it wasn't just the pandemic. It was the pandemic. It was oil prices collapsing. It was interest rates collapsing. The pandemic, plus an election year, all kind of created this massive bit of volatility. And one of the important things to know from a technical perspective here is what you are seeing on the right-hand side. And what you're seeing on the right-hand side is a representation of the amount of volume that's traded at a certain price. And not to get too deep into the weeds here, but just know that there was a lot of volume that was traded back in, say, 2014 to 2016 during this consolidation phase of the market. That market was a rough one for anybody who was trading it and investing. It just seemed like everything was kind of stuck in the mud. But you're talking about months upon months, two full years of really just sideways action. And it really didn't break out until about November of 2016. So, you had a moment in time where prices were really just gravitating, oscillating even around kind of this point right here, say around 2000, 2100. People are starting to look down right now. So what happens is when you see a little bit of red in the market, people stop looking up and they start looking down. And I've seen people start mentioning that, okay, well, we may make a third low. We may take out the March 2020 lows. And to put that into perspective, if we were to do that, that would be about a 40-something% correction from where we are now. That would put us into a global financial crisis .com bubble style correction. If that were to happen, that is your worst case scenario. And the reason why it gets back down to these prices is because, again, not to get too into the weeds, but you'll notice how there was a lot of volume traded through, say, 2011, 2016. All of a sudden, the volume kind of just dropped off, right? And as this market kept going up, it was going up with very little participation. And one of the things that was really happening in 2017, 2018 is something, and I don't think I have it saved, so now you're going to have to bear with me. But let's see. Global Fund Manager Survey. Let's see. September. So one of the really important things to note is that a market can go up on low volume. It doesn't need heavy volume to go up. And that was obviously the case from the run that it made from November 2016 to the top, with 30-something% run in about, let's call it 18 months. So it made that big run on low volume. And one of the interesting things about that, if I could find the chart, because I know it's here. Here we go. So what this is the evolution of the Global Fund Manager Survey most crowded trade. What this is it represents what the fund managers believe is the most crowded trade, meaning that everybody is in this portion of the market. This is where everybody is going for performance. This is where everybody's going for momentum. This is where everybody's going in a weird way for safety even. So long U.S. tech, you can see this is May 2019. Long U.S. tech or long U.S. treasuries has been the trade to be in for the better part, for more than a year, about 18 months now. What's really interesting too, you'll notice before that, long fang. What this is, that's essentially long U.S. tech and growth. The FANG trade really got going in 2018. Just understand that for the better part of the last 2.5-3 years, it's been all tech, all FANG, which is Facebook, Apple, Amazon. You could even say Microsoft, Netflix, and Google has been the trade to be in for the better part of the last 3 years. And surprisingly so, if you think that's like a risk sector, well, they were loading up in U.S. Treasury bonds as well. And U.S. Treasury bonds is normally known as like a defensive play, right? If you want to go risk off in your portfolio, you get into U.S. Treasury bonds and you get into cash. It's pretty much one or the other. So it's been that weird kind of combination of dive into growth, dive into defense for the better part of, 2 or 3 years. So what's really interesting about that, and to get back to the volume discussion, is that the volume started ticking up again in a major way from this pullback. And this, in my opinion, would be a positive, that this would be like a part of the best case scenario, that it doesn't ever touch these lows again. And the reason for that is that people started really joining in on this dip. It was a significant amount of volume that got created that helped us toward the upside once this flush happened, that 35% drop. So to kind of zoom in a little bit to what's been happening recently, we're down about 10, say 8 to 10%, right, over the last month since the beginning of September. Also something to note, and again, back to technical analysis, but just understand, is when you get these fast moves up, that creates risk, right? You're going parabolic. There's no stopping it. It just keeps going up. And what that does is it drags a bunch of people in just to get washed out. you'll notice that I have this tiny X and this little kind of consolidation pattern. Well, this consolidation pattern happened it was pretty much the whole month of June into July. And so we had a really big drop. I think it was, yeah. So we had about a 8% drop in June. And it did create a little bit of a volume shelf here, as you could see. And what's really important is this X represents the election date. And the reason I put that there is because 2020 will make 2016 look like a walk in the park. There is a massive amount of fear out there either way. It does not matter if Trump wins or if Biden wins. There is a ton of fear of the aftermath of the election, not the election itself, the aftermath. So regardless if it's Trump, regardless if it's Biden, the worst case scenario is that we will see tons and tons of riots either way. It's going to get ugly. It's going to create volatility in the market. And what I think would be a very healthy thing is if we ended up coming back down to this level and giving it a test. It's something that's about a 15% correction from the recent high. I think that would be super healthy. We were talking, and you noticed that I had mentioned a bunch of times on the way up, is that we needed some kind of pullback to just kind of relax some of the tension that the rubber band, like this just pulling the rubber band so high so quickly. You didn't want to create a snapback effect, so you wanted these kind of like slow grinding consolidations, and that's hopefully what we're going to be getting over the next 3 to 6 months. So I don't think the election is going to be, I don't necessarily think this is going to be the top for the next year, but I do think it's the top for at least the next 6 months, at least. So so this is a level that I'm really interested in. I'm starting to raise cash just because I do believe that even if we bounce here, which I think we're going to be doing next week, even if we bounce, it's nothing more than like what they call a dead cat bounce. I think we're going to be putting in some kind of longer term consolidation pattern that brings us down to that level one way or the other. And again, the election and the news cycle and the headlines, it's all going to create a bunch of volatility that's going to scare the heck out of people. And you're going to get these really fast moves down that it's going to be violent, and it's going to end up being an opportunity. But in the moment, it's going to feel terrible. So that's what we got on tap for the next 3 to 6 months. Just expect that we get a bounce into next week, and then I think we're still going to end up grinding down. What's really interesting is, and I should have done this with you folks a lot sooner, is just get everybody on the email thread comfortable with understanding sectors. And the best way, first off, humans love kind of putting things into baskets. It helps our minds organize things and keep things simple for us to understand. So these are, and you could find this is the sectorspider.com. This is basically just a bunch of ETFs that represent certain sectors. So communication, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, technology, utilities. You could see that energy is such garbage. It is so bad over the last 10 years. This year to date, it's lost 38%. 3 years, it's down 13% annualized. 5 years, 8%. That means you lose 8% of your money every year over the last 5 years. Over the 10-year, you've started to lose money now. I remember when this was green not too long ago. Not anymore. And since inception, 4.20%. What's really interesting is if you look at financials is up actually less since inception, which is the inception of the ETF. But still, right? So you can see that the communication services, top dog, consumer discretionary plus 10%, technology 8% ish, and then healthcare 8.73% since inception. But you can see over the 10-year, and this is really good to just get a feel for what is and isn't performing. Like you could see that energy's been a dog this month, utilities has been a dog this month, but communication services, consumer discretionary, these have been all right. The latest quarter, again, just over the last 3 months, how are these sectors doing? Energy has just been so bad, but what's really interesting too is financials, and we've talked about this before as far as jumping into FinViz, but you could get some really really good. If I just go, let's see, financials, energy, right? Financials and energy, and just pop a dividend yield over 5%. And you could just see, obviously, you want to get rid of some of these ridiculous ones. It's because their price has been getting hammered. They're probably not going to be able to pay their dividend for much longer. But there's a lot of companies out there, even if I just do debt to equity under 1, that'll help the. So you can see just tons, 9 pages times 20, right? So 180 stocks with a dividend over 5% in the energy and financial space with debt to equity under 1. So it's really important to see that, because you're not getting any kind of dividend yield from a bond. You're not going to be getting any kind of dividend yield from cash, obviously. So there goes your safety net, right? It's not like you just get into a bond at this point and be like, oh, okay, well, I'm safe now, because that used to be the old theory. But you have bonds still near all-time highs. And at the same time, and we've talked about this, I believe, before, but if you were just to compare it to its yield, inverse correlation. So bond yields, you can no longer get into a bond. You're getting into bonds at all-time highs. Yields near all-time lows. So just keep that in mind. There's bonds, especially if you're young, bonds should have 0 place in your portfolio. 0. If you're older and you're worried about the market, I would worry about putting my money in bonds. If you want safety, you're going to lose money on a real basis either way, right? Versus inflation, if you're in a bond or if you're in cash, you're going to lose money, period. So you might as well get some of these sectors, right? Like an energy or financials, or if you were to look at them, XLF, right? Off the highs, 32% discount, currently at about 24% discount. Energy is even worse. Energy is obviously just, again, an absolute dog for the better part of 10 years, somewhere around here. It's bad. But again, you're buying it at a low. Buy low, sell high. If you have a long enough time horizon, you could be soaking up a ton of dividends, in the meantime. I think that's very important right now, because even if this comes in a little bit more, which it very well could, at least it'll be paying you a dividend, versus being in something like a shop where, okay, you had this explosive performance, but now you're at the peak of that performance. So do you want to buy here, take the risk of some kind of 10, 20, 30, 40% pullback, which, I mean, look, from the high, and you've seen these before. Like, you could just go back to Microsoft back in, it's not like a good company can't come down, right? It's not like a good company can't lose 30, 40, 50, 60% from the high. So it happens all the time. So no matter how much you like Shopify, AMD, just another one, right? Everybody knows AMD. That got cut down 90%. That's been cut down 90% a couple of times. So if you think it can't get cut down again, it very well could. And some of the most, and I remember looking at these a month or two ago, and we hadn't seen a red candle yet, right? And so from a monthly perspective, this thing just kept going and going, and now you're at a point where it finally caught some red, and it caught it in a pretty bad way. And so, that's your risk. Look how quickly Coop lost 30 something percent, 32% in a month. So just understand that even if you really like technology, even if you really like software, they don't pay you a dividend, and their current risk premium at these prices is extremely high. You're paying an extremely high risk premium to be in at these prices. Just wait. Just wait if you want to invest in these companies. Again, a lot of these software companies are going to be very, very good for us in the long run. But right now, they just got carried away, just like everything does. It happens in cycles. You don't buy up on parabolic moves for an investment. If you want to trade these things, great trading vehicles. If you want to invest in these things, not at these prices. So you can use Sector Spider ETFs, or you can use Vanguard ETF list, either or. They have all the same sectors, just different tickers. They have obviously different inception dates too. But I think you just need to get comfortable with these and understand, what's really been like. Look at technology this year, up about 60% in a year, right? So year to date up 35%, but over the past year, the last trailing 12 months, 57%. That's just incredible. So you have this going up 57% in the last 12 months, and you have energy down 32% in the last 12 months. It doesn't mean, I think we may have mentioned this last time. It doesn't mean, that you snap your fingers and all of a sudden all the fund managers are going to just start throwing their money into energy. That's not going to happen. But the point is that if you invest in energy right now, very, very low risk premium for more downside. Very, very high risk premium for more downside. And if it does end up reverting to the mean, you're going to see a lot of money flowing back into energy and financials. And here's the kicker. So we haven't seen inflation in this country in a very, very long time. If we do get inflation, which we will, because we just threw trillions of dollars into the economy, right? So when you throw trillions of dollars into an economy, that's going to end up ticking up inflation. It's not going to tick up inflation immediately, because the only way that it could tick up inflation is if we get back to high GDP growth and if we get back to low unemployment. So until those two things happen, we're not going to see a ton of inflation. But just understand, I'll bring up the TNX again. Yields can't go much lower, right? The 10-year Treasury yield can't go much lower. And the Federal Reserve has just said for the next 3 years, they're going to keep rates really, really low. You have to understand that if this stays down here and just hovers around here for the next 1 or 2 years, at some point, it's either going to go negative or it's going to go up. And there's a much higher probability of a United States Treasury note, Treasury bond. There's a very, very low chance that a U.S. Treasury bond goes negative. Very, very low chance. So the probability that it ends up ticking up and we start seeing inflation in this country is much higher than seeing negative yield. So with that said, from a sector perspective, energy, financials, industrials, materials benefit, and to some extent consumer staples benefit from higher inflation. What doesn't benefit is technology and consumer discretionary. Consumer discretionary, what happens with them is that all the commodities start going up in price, and it costs them a lot more. And they have to start raising their prices, and then people won't pay those prices. For technology, if they want to continue growing, they have to start paying higher interest rates as inflation ticks up. That's a problem. So because interest rates are really low right now, technology can borrow, they can grow, they can do everything they want to do with all the free money that's going on out there. But if inflation starts ticking up and the interest rates have to go with it, that's going to be a problem for technology. One of the last points I wanted to make is, and this may be for the older portion of the crowd, I just want to talk a little bit about my current approach to portfolios in terms of if you want to put together a portfolio of mutual funds and ETFs, no individual stocks. My thought process, and I would, if anybody ever wants to have a discussion about this as far as long-term investments, my thought process is that if we know growth is overbought right now and overweight, and if we know that a lot of the value sectors are underweight and underbought, that if you do want to participate in growth, you should do it with a mutual fund. And that's because mutual funds are a lot more actively managed. So, go to good old Investopedia if you don't know enough about mutual funds and ETFs. But, mutual funds are much more actively managed. They tend to do a better job at momentum and trend following than ETFs. ETFs are much more passively managed. Basically, a mutual fund manager actively tries to beat the market, where an ETF is more just like a basket of stocks. But ETFs tend to be much cheaper as far as the management fees go. So what I would do is I would take shots at energy, financials, industrials, materials, and what I would do is I would use ETFs for those sectors. So jump in the ETFs of those sectors, lower fees than mutual funds, and you get the broad basket, right? But you don't want to take an ETF for technology. And the reason is you need that to be actively managed at this point. So why does it need to be actively managed? It needs to be actively managed because you need somebody to be looking at, one, the PE ratios, which are out of control. But two, you need somebody to actually just be looking at the charts, right? You need somebody to say, okay, I think it's time. I think it's time to get out. I think it's time to, sell at a high and take some profits on this trade, on this investment. So you don't want to just get a sector ETF that just broadly goes after the technology sector. That's just it's not a good approach if you think the vast majority, like I do, of technology and growth is overvalued. So again, the quick point I'm trying to make here is that use these ETFs as a broad, like if you were painting a wall with a roller brush, right? You're gonna broadly paint, you're gonna broadly invest in that sector. With technology, you want to be a little bit more pointed. You want an actively managed fund manager to be getting you in and out of the parts of technology that's overvalued. There's still some technology that's undervalued at this point, but the vast majority of funds aren't in that yet, right? They haven't rotated out of the things that have too much investment that are overvalued. They haven't rotated out yet. So you want to find mutual funds, and you can do it just no different than looking at a Vanguard ETF list. You can look at a Vanguard mutual fund list. And let's see if I can pull that up real quick here. Of course you're not going to make it easy for me, are you? Let's see. Investing, Vanguard mutual funds. There we go. Or not. Oh, you're going to see me struggle through this for a second. Really? There we go. So you can just go into mutual funds, and they kind of break it up: investment grade bonds, tax exempt bonds, all that kind of stuff, target date funds. Hate target date funds, garbage ass stuff. You do large cap, like growth and income, growth index admiral shares, high dividend yield index. I use that one a lot, large cap value. But again, if you want to do like large cap growth. So you could always use that, large cap growth. And again, what you're getting is you're getting an actively managed fund. You're getting a manager who's going to be, go to portfolio and management here. So you're going to be getting, see, tons of technology, but notice what they have, the top 5, and we've talked about these before. So essentially, their large cap growth fund is the S&P or the NASDAQ, right? Look at Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, right? So that's the thing I'm concerned about, is that at some point, these fund managers are going to be pulling out of these. And when they do, this market's going to get hit. So, but understand, and here's the thought on that too, is that just like those companies were dragging the market up, putting the market on their back, those companies are going to be pulling the market down. And until the rotation happens, like you can get a down market. You can get a down market where the market goes like this, down like that, while value goes up like this. So, that's happened plenty of times in history, and there's no better way to look at that actually than if you would just take the SPX, which is the S&P 500, right? And you were just to compare it to, let's see if this I don't know if this is going to work. I don't know if it's going to go back far enough. Kind of. So if you just take like, I don't know if maybe energy might work. Maybe industrials. XLF, did I already do XLF? So you could see, so if you take it from the top in 2000, let's see if I could just get it teed up here. So there you go. So the market is the black line. So the black line represents the market. So you had, let's see, you had financials. Oh, well, that's because that's the global financial crisis. So let's see if we could get it. So for the better part of the early 2000s, you had materials outpacing the market. You had energy outpacing the market. You had industrials somewhat outpacing the market. And you had financials. So materials, energy, industrials, financials. They all outpace the market, some more than others. So the point is we've seen that happen before. We've seen the market come in and these sectors rally. So in the face of that, just understand that if the market comes in, it doesn't necessarily mean that energy is going to continue to take a digger. It doesn't mean that financials, industrials, and materials are going to take a digger. And one of the other things that I like to do, and this is a little bit more granular, but what you can do too is like, let's just take, well, I don't know what the best way to do this is. Let me see here. Just show you like a divergence. Let's see. A little too much going on. And just see if materials, I think materials had the better. So let's see here. So early September, let's do this by the daily. By the daily here. And see if we could spot. I thought there was a divergence earlier in this process where, right, so there it is. So what I mean by divergence is that, so look at this. So the black line is the S&P 500. So the S&P 500 started going down. So from September 2nd to September 15th started the downtrend, right? However, what may have gone under the radar is that the materials sector actually took out its September 2nd high. So as the S&P started going down, right, down, and materials took a little bit of a hit too, this rally here that happened in the S&P 500, it happened in a much greater way in the materials sector. So materials took out the high, came down. So what this represents is that materials had relative strength in that moment. So what's happening now is that you have materials broke out to a new high, now pulling back just like the S&P. And now what you want to watch for the next step here is that on the way up, if the S&P makes another low and the materials don't. So if the material sector doesn't make another low while the S&P does, that's a very good sign that materials are going to end up leading the next leg higher. And vice versa, right? So if materials make a new low and the S&P doesn't, it means materials are going to probably end up lagging. So these are the kind of the divergences I look for on more of a daily basis, more of like a week to week, month to month kind of thing. It doesn't necessarily apply to investing, more to trading. But what I could show you too is that, and again, this kind of gets a little granular, so bear with me here. But if you were to go back to 2018, right here. So during that kind of big old market route, if you were to compare the S&P to, let's see, what was it? Was it software companies? I know it was software, but I got to figure out if got to really zoom in here. Right. Yeah, I think that's it. So while the S&P, which is the black line, was going down, right? So low, new low. The software, and I think I'm using Coop right now, but I think you could use Team Shopify around back then. A lot of the software companies didn't end up making, or maybe they did. There was a sector, I don't know, but I guess forget that point. I'd have to pull it up a lot sooner and pull it out for you guys. But some of these divergences do happen, and it has a lot to do with risk on, risk off. If I was just to compare the S&P to the IWM is the Russell, which is small caps. So if you get into small caps, it tends to be more risky. So what was really interesting prior to March is that the IWM did not make a new high while the S&P did. And so what that means is it means that as the S&P was going higher, the people who were risk on, which if you get into small caps, it means you're risk on, we're not investing as much as the S&P. So these divergences kind of stick out to me. They do kind of help. They mainly help for trading. They somewhat help for investing. But it's just something that I take a look at, and something that I'm cognizant of when we're looking at kind of these pivot points in the market. So I think that was it. So again, I think we're going to see plenty of volatility heading into the election. And I think we're going to see plenty of volatility after the election. This X is going to stay up. I'm not moving that X. So that's the election date. So we're going to see how far this comes in going into that election. And then we're going to see where it goes after that. But just be cognizant that it could get pretty scary out here over the next month. And regardless of any kind of up moves in the market over the next week or two, do not think you're out of the woods yet, because that was a pretty enthusiastic push up, and that was an immediate rejection down. So let's just see if this grinds it out, or who knows, maybe we just keep heading back to new highs again and again. So that's the market update, everybody. Again, if you have any questions, if you want to talk over portfolios, ETFs, mutual funds, stocks, whatever you want to talk about, feel free to ask away. And that's it. So everybody have a good one. Take care.